Good morning. Welcome to this virtual learning program prepared by Rainbow International School. And we are about to discuss chapter 9, and this is only the first part of the topic. We shall be taking up today analysis of accounts. It's taken from chapter 26 of our textbook, IGCSE Business Studies, 5th edition, authored by Karen Borrington and Peter Stimson. In this chapter, we shall be discussing the concept and importance of profitability and liquidity. We shall also be discussing how to interpret the financial performance of a business by calculating and analyzing profitability ratios and liquidity ratios like gross margin, net profit margin, return on capital employed, current ratio, and acid test. We shall also be discussing the needs of different users of accounts and ratio analysis. And the last part of this chapter 26, we shall be discussing how users of accounts and ratio results might use information to help make decisions, for example, whether to lend to or invest in the business. Now, the first part is the analysis of published accounts. As you will remember, we have discussed what is referred to by company accounts, or the so-called financial statements, and we have to remember also that these published accounts of limited companies are made available to all those interested in the performance of the business, and that's what we call, who remembers, stakeholders, right? They will analyze the company accounts. Okay, so now we must look at how these accounts can be used and analyzed to give the information these groups need. We have here the question, what is meant by analysis of accounts? Okay, according to our textbook, it means using the data contained in the accounts to make some useful observations about the performance and the financial strength of the business. And without analysis of accounts, it's impossible to tell whether a business is performing better this year than last year, or performing better than other businesses. Okay? Now, for better understanding, you will find in your textbook on page 311 a case study, and let us consider those results for two food retailing companies. You will see that we will be referring to Fresh Foods Public Limited Company and Food Store PLC as well. The net profit gain in 2018 are $300,000 and $30,000 respectively. Now, what conclusions can be drawn from these two figures? Is Fresh Foods PLC much more successful than Food Store PLC? Now, you will see the figures and you may be biased because, as you see, Food Store has a lesser profit displayed on the table. But let us try to go on and see if this information is enough to make our analysis or decision. Another question to consider is the management of Fresh Foods PLC 10 times more efficient than the management of Food Store PLC? Again, as we can see, probably yes, and some may say no, but we don't have enough account to make our decision valid or credible. Another question that we might want to ask is Fresh Foods PLC making much better use of its assets than its competitor? Uh, Again, we may not have enough uh, reference to answer this question. And the other question that we might be asking is the profit margin made on each item sold much higher in one company than the other? Oh, this is not enough. This account, the net profit, is not enough for us to tell whether the profit margin made on each item sold is much higher in one company than the other. Okay, so definite answers to these questions cannot be given unless other information is considered. So let's take, for example, the total value of capital employed by both these businesses. Capital employed is defined as the shareholders' equity plus non-current liabilities. It is the total long-term and permanent capital invested in a business. A businessman, a capitalist, when he or she invests an amount of money, it will be classified as a capital employed account. Okay, so now let's try to take the capital employed data, extract it from our financial statement, and let's take the Fresh Foods PLC as PLC's capital employed in 2008, and it was like $900,000, and for a food store it's $60,000. Now let us try to look at these figures in front of us, and let's go back to those questions and check whether we may be able to answer them. But we may further ask, which company seems to have made more efficient use of the capital invested? We need to compare the net profit made with capital employed in each company. Food Store PLC has made $30,000 profit from an investment of $60,000, right? And Fresh Foods PLC has made $300,000 profit from an investment of $900,000. Now, by comparing these figures from the accounts, Food Store PLC appears to have achieved a better performance even though its overall level of profits is lower. Do you see the difference? Now we shall be taking the different ratios for us to be able to enhance our decision making given all these liquidity and profitability ratios. Okay. Okay, so the example in the cases studied in the preceding slides shows how important it is to use more than one figure from the accounts when trying to assess how a business is performing. Comparing two figures from the accounts in this way is called ratio analysis. This is a very important way of analyzing the published accounts. Now, we have many ratios which we can be calculated from a set of accounts, and we shall be discussing about like 5 only of the most commonly used accounts. These ratios are used to measure and compare profitability or performance and liquidity of a business. So we shall be having from profitability ratios, or to check the performance of a business. We have 3 ratios, namely ROCE, or the return on capital employed, gross profit margin, and net profit margin. Net profit margin is the so-called profit margin. It is the final profit being taken when presenting any financial report. And for the liquidity ratios, we have 2 kinds, the current ratio and the acid test ratio. Alright, before we proceed, let us try to get the definition or concept of profitability. From the word profit, which is an amount of money the business has made after all costs have been taken off revenue, we are able to derive the word profitability, which is the measure of the profit made relative to either the value of the sales achieved or the capital invested in the business. Now, profitability is measured in percentage form. It is a measure of efficiency. It can be used to compare the business performance over a number of years to check perhaps whether a business is doing well, and if not, measures may be taken to save the status of the business. It can also be used to compare its performance with that of other businesses, and this is to know the place of the business in the market. Okay, so from here we may proceed to knowing the importance of profitability. Now, why do we have to check on the performance of its business? What is the importance of profitability? Let's see, it is important to investors when deciding which business to invest in. It is also important to directors and managers of the business to assess whether the business is becoming more or less successful over time. This might lead to the directors and managers needing to change the operations of the business to improve performance or profitability. Now let's go to these different profitability ratios. As you can see, we have 3 formulas here. ROCE to find the return on capital employed, gross profit margin formula, and the net profit margin or profit margin formula. As I mentioned earlier, profit margin or the net profit margin is considered the final profit figures in any financial statement. For better understanding, we shall consider the case study on page 313 to apply the formula to find the return on capital employed. And we have here, based on the case study, ABC Computing Limited made a net profit of $280. So based on the formula, the numerator will be the net profit, which is $280. And in 2018, also as well, the capital employed was $1,065 million. So its return on capital employed in 2018 is found in this slide. you have the percentage result, which is 26.3%. Now, let's try to see the analysis of these figures. The company made a return on the capital employed in the business of 26.3%. It's positive. It's not a loss. It's a gain. The higher this result, the more successful the managers are in earning profit from capital used in the business. And if this percentage increases in 2019, it means that the managers are running the business more efficiently, making higher profits from each dollar invested in the business. This result should be compared with other years and other companies to see if the managers are running the business more efficiently or not. So if we have the figures on net profit and capital employed from 2017, we may use that result with compared to this result, 26.3%, so that the investors would know whether the business is doing good. Should they invest in this business? Will they take the chance, the risk of doling out their or investing, using their money, giving out their cash as capital, part of the capital of the business? Now let's try to see the case study to apply the two other formulas under considering profitability or performance of the business. Now we have the case study again on page 313, and the case study is an application of the gross profit margin formula. And as we see, we're using again ABC Computing Limited, which made a gross profit in 2018 of $400 million. The revenue was $1,300 million, and we shall use this formula to come up with 30.8%. Now the analysis to this figure is that on every dollar worth of goods sold, the company made on average 30.8 cents gross profit. Remember, we're using the dollar denomination, so our halala to be considered here is in cents. This is before other expenses have been deducted, meaning this percentage, this gross profit is taken from the profit from sales. In order to come up with the net profit, we have to consider the expenses to be deducted from this gross profit. So now this figure we have here is before deductions will be made. This is not the final profit of the company. Now this result can be compared also with other years and other companies to check on the performance of the business, whether it's doing good or otherwise. If this percentage increases in 2019, it would suggest that the prices have been increased by more than the cost of sales has risen, or maybe the cost of sales has been reduced. Probably a new supplier is being used, or managers have negotiated lower cost prices. And the case study on page 314 is an application of the last formula under profitability ratios in order for directors and investors to make decisions for the business ABC Computing Limited. Now, as you see, we have the formula given, and this is the application considering the net profits and the revenue on page 314. The analysis is the company made 21.5 cents net profit on its dollar worth of sales. Okay. This is lower than the gross profit margin because all other expenses, including interest, have been deducted from gross profit to arrive at net profit before tax. So again, it's mentioned here that although we deducted already the expenses from the gross profit, tax will come later. Okay? The higher this result, the more successful the managers are in making net profit from sales. What could this result be compared with? Again, it should be compared with other years and other companies. Okay, what do these profitability ratios tell us? One profitability ratio result is not very useful. When a ratio result is compared with others, only then some effective analysis can be done. We have a table below wherein you will find the three different ratios applied, the observation respectively, and analysis as well. Let's take for instance the gross profit margin. In 2017, uh, the gross profit margin using to find the profitability ratio is 20%. In 2018, it's 24%. So what's the observation? Gross profit on each dollar of sales has increased. And the analysis is the business is more successful at converting sales into profit. Because as you see, there's an increase, right? Either the profit of, the price of goods has increased by more than costs, or the cost of sales has fallen, but the price has not been reduced at all or not by as much. Now let's go to the net profit margin. As you will see, in 2017, it's 14%, and 2018, it's 12%. Let's see, what's the observation? Net profit on each dollar of sales has fallen, even though gross profit margin has increased. The business, based on this analysis, is less successful at converting sales into net profit. The overheads or fixed costs of the business must have increased significantly during the year, thereby reducing the company's net profit compared to revenue. And the last is the return on capital employed. 2017 is 10%, 2018 is 6%. Now the observation is that profit made for each dollar invested in the business has fallen. And what's the analysis? Either the net profit has fallen or the capital employed has increased. If capital employed has increased, this could mean that the managers of the business have invested more, hoping to make higher profit in the future. So we're done with unlocking the difficulties in profitability, the concept and importance, and the different ratios. Now let's go to liquidity. You'll find in this slide the concept and importance of liquidity. It's on page 315 of your textbook. Liquidity means that assets are not easily convertible into cash. If a business cannot pay its suppliers for materials that are important to production, or if the business cannot repay an overdraft when required to, it is said to be illiquid. The businesses it owes money may force it to stop trading and sell its assets so that the debts are repaid. So when you say liquidation of assets, that means trying to sell or get rid, perhaps through bidding or private or personal selling, and the goal is to acquire cash in order to pay or repay those people who are expecting payment from the said business. Okay, so next slide, we shall go to the liquidity ratios. In this slide, you will find the different formula of the two types of liquidity ratios. Current ratio, which is equal to the current assets over the current liabilities times 100. And acid test ratio is also uh, equal to current assets, although this time inventory should be deducted, over current liabilities times 100. And let us try to see, check an application on the next slide. Okay, now considering this case study on page 315, we may apply the current ratio formula, and we shall be considering also the same company. The analysis for this result is, first, the business could only just pay off all its short-term debts from current assets. 1.25 is an acceptable result, but a really safe current ratio would be between 1.5 and 2. If the current ratio is less than 1, it would mean that the business could have real cash flow problems. It could not pay off its short-term debts from current assets. More effective analysis of liquidity is possible if results for previous years and other similar businesses are available. If the current ratio is very high, say over 2, it could mean that too much working capital is tied up in unprofitable current assets. The current ratio is useful, but it assumes that all current assets can be turned into cash quickly, which may not be the case sometimes. This is not always the case. It might be very difficult to sell all inventories in a short period of time, and because of this, a second liquidity ratio is used. And now for the acid test ratio, which is the second liquidity ratio, we will consider the same case situation of ABC Computing Limited, and we shall try to use their situation to this test, whether this test or this ratio is applicable to their situation. So given the same situation, we have the analysis made. As a result, of 1 would mean that the company could just pay off its short-term debts from its most liquid assets. This is an acceptable acid test result. The company cannot do this test, however, because of the 0.7 result. This might be worrying for the management, and the steps may have to be taken to improve the liquidity of the business, like reducing the level of inventories by selling some for cash. And so we see that this is the current situation, or the would-be situation of the ABC Computing Limited if they would be applying these two given formula or given ratio. Now, what can these ratios tell us? One liquidity ratio result is not very useful. When a ratio result is compared with others, then some effective analysis can be done. It's very similar to uh, the relevance of profitability ratios. Now, given the table below, you'll find ratio results, the observation, and the respective analysis. For the current ratio of 1 in 2018 from the current ratio of 1.5 in 2017, the observation is the current ratio has fallen between 2017 and 2018. So the business has brought and used many more supplies as analyzed, but not yet paid for them. The business has used cash to pay for fixed assets. And for the second situation, the current ratio 1.75 in 2018, and another test conducted, another using the same situation, acid test ratio resulted to 0.5 in the same year. The current ratio is acceptable and much higher than the acid test ratio in 2018. And what's the analysis? The acid test ratio might be too low. The business might be at risk of not being able to pay its short-term debts from its liquid assets, cash and accounts receivable, or debtors. The great difference between the two results is because of a relatively high level of inventories, and that is the analysis made for these situations. Now, you are tasked to solve or do activity 26.1 and activity 26.2. They are found respectively on pages 314 and 316. Now, I have given these guide answers so that you may know how to go about with the case study or the activity. But in the next exercises, I won't be giving you the guide answers. You have to solve them and try your best. And during the next discussion, or before we go to the next discussion or next video presentation, we shall be discussing the tasks given to you. Okay, just so to make it easier for you to solve the problem. You may want to solve the activity problems, but it's your choice, and then consult for correction using this slide. Okay. Okay, that ends our presentation for today, and there will be a second part to this presentation. The continuation will be uploaded soon, and that will be about pages 316 up to 320, and we shall be discussing also the exam style questions, short answer and data response on page 321, and the international business in focus on pages 319 to 320. Okay, so we shall also be discussing the booklet revision questions and answers, and also the MCQs. So for now, take your break, and I hope you'll find time to go over this presentation once again for better understanding, for enhancement, so you may be very familiar with how profitability and liquidity goes. Okay, that's all for now, and happy virtual learning. Bye, and take care as always.